Unlocking Wealth, your ultimate guide to investing in Nigeria. Introduction. Investing in Nigeria can be a lucrative venture, but it's essential to understand the current market trends and economic conditions. In this video, we'll explore the pros and cons of investing in Nigeria, discussing the potential risks and rewards. Whether you're a seasoned investor or just starting out, this video will provide valuable insights to help you make informed decisions about investing in Nigeria. From the country's growing economy to its rich natural resources, we'll examine the key factors that make Nigeria an attractive investment destination. So, is it time to invest big in Nigeria? Watch to find out. Nigeria at a glance. Macroeconomic overview and Nigeria's investment appeal. Nigeria is often called the giant of Africa, both in population, over 220 million, and in economic influence. It's the largest economy in sub-Saharan Africa by GDP, with vast natural resources, notably oil and gas, solid minerals, and arable land. It also has a youthful and growing population, a rising middle class, and increasing urbanization. These demographic strengths point to a large and expanding domestic consumer base. Its economy is not without challenges, but the growth potential is visible. In recent years, the government has embarked on reforms to liberalize foreign exchange, reduce subsidies, and stimulate investment. Foreign capital is returning, and Nigeria has begun to attract renewed interest from portfolio investors. For example, capital inflow into Nigeria more than doubled in the first half of 2024 compared to corresponding period a year earlier. Notwithstanding, investing in Nigeria calls for both optimism and caution. One must navigate macro risks, institutional gaps, and currency volatility. Why Nigeria's potential still matters. Here are some of the structural advantages that continue to make Nigeria a compelling prospective investment destination. Resource endowment. Nigeria is a major oil and gas producer, and beyond petroleum, it possesses deposits of gold, gemstones, limestone, and other solid minerals. Large domestic market. Few African countries offer such scale in consumer demand, especially in sectors like telecoms, agriculture, fintech, retail, and consumer goods. Digital and fintech boom. Nigeria is among the leading African countries in fintech adoption, payments innovation, mobile money, digital banking, and startups. Diaspora and remittances. Remittances from Nigerians abroad bring in significant foreign exchange, helping ease forex constraints. For instance, foreign exchange inflows to Nigeria surged since 2024, partly driven by remittances and foreign investor interest. Policy reforms and liberalization. Recent moves toward a more market-determined foreign exchange regime, removal of fuel subsidies, and improved transparency signal a willingness to modernize. Growing integration with global investors. Nigeria is increasingly being included in frontier and emerging market indices, which can lead to automatic capital flow from index funds and ETFs. Nevertheless, despite all the upside storylines, Nigeria is not a frictionless market. There are serious risks to appreciate. The risks and headwinds. Currency, governance, liquidity. Currency depreciation and volatility. One of the thorniest issues confronting Nigerian investors and foreign investors in Nigeria is the chronic depreciation of the Nigerian naira. Over the last decade, the naira has experienced multiple rounds of sharp devaluations, and many investors have been caught off guard. In the first half of 2024, the naira was named the world's worst-performing currency, weakening by 40%. Since Nigeria pivoted to a more flexible FX regime in 2023, the naira has lost over 70% of its value against the US dollar. Historically, studies show that currency depreciation correlates negatively with stock market returns in Nigeria. One such empirical study found that exchange rate fluctuations have a negative impact on capital market performance. Given how much the naira can swing, unhedged exposure to domestic capital assets carries substantial FX risk. In short, your local currency gains can be wiped out or even turned into losses once converted to dollars, or your home currency. A 50% currency drop can turn a solid 30% nominal return into a negative real return in foreign currency terms. Governance, policy uncertainty, and regulatory risk. Nigeria's regulatory and governance frameworks remain evolving and can be unpredictable. Regulatory changes, especially in sectors like telecoms, energy, power, import-export restrictions, and foreign exchange controls can shift swiftly. Political transitions, populist pressures, and fiscal imbalances may lead to policy reversals, e.g., subsidy reinstatement, trade interventions. Corporate governance in many firms remains weak with issues of minority shareholder rights, opaque related party transactions, and weak enforcement. Permit delays, infrastructure deficits, power, roads, ports, and corruption still exact a tangible drag on business performance. Some companies listed in Nigeria derive part of their earnings from offshore operations governed by stricter regimes, which is good, but their domestic exposure still faces local risk. Market liquidity, capital controls, and foreign access. Liquidity in Nigeria's capital markets is relatively thin compared to global markets. Some constraints to be aware of are: there can be wide bid-ask spreads and difficulty exiting large positions without pushing price. Capital controls or FX restrictions may limit repatriation of funds or slow down withdrawals. At times, foreign exchange scarcity leads to delays or withholdings on foreign currency remittances. Foreign investors' appetite can be fragile under stress, leading to sudden capital outflows and market volatility. Inflation, interest rates, and macro instability. Nigeria has long battled double-digit inflation, often above 20%. Monetary policy frequently keeps interest rates high to contain inflation, which raises borrowing costs and can slow corporate growth. If interest rates rise sharply or inflation accelerates, equity valuations can suffer. Also, Nigeria often relies on external borrowing, which in turn increases sensitivity to global interest rates, commodity prices, and capital flows. Given all these risks, any investor in Nigeria needs to think defensively and diversify smartly, especially across currencies and geographies. That brings us to the strategic approach. Disclaimer: this video is for informational purposes only and does not constitute financial advice. The content provided is based on publicly available information and is subject to change. Always do your own due diligence before investing. Investing in Nigeria: opportunities across asset classes. Before diving into specific portfolios, it helps to survey the spectrum of investment options in Nigeria. Equity/stock market. The Nigerian Exchange, NGX, lists dozens of companies across sectors like banking, telecommunications, consumer goods, industrials, energy, and insurance. Advantages: access to local growth stories, especially in sectors where foreign capital is scarce. High dividend yields in some sectors. Some firms have cross-border operations, which may cushion local volatility. Fixed income, bonds, and treasury bills. Nigeria issues local currency government securities, NTBs, FGN bonds. For domestic investors, these can be relatively stable yield vehicles. For foreign investors, they carry interest rate risk and FX risk, but can be attractive when yields are high. Real assets and private equity. Investments in agriculture, real estate, logistics, energy, infrastructure, and private equity, venture capital, can yield outsized returns, but these are less liquid and require more local knowledge and due diligence. Commodities and resources. Direct investment via resource projects, mining concessions, or upstream energy, often via local partnerships or joint ventures, can be lucrative but require large capital and strong local governance. Other vehicles are mutual funds and equity funds managed locally with foreign access, diaspora-friendly platforms, dollar-denominated bonds and diaspora bonds, foreign listings or cross-listed securities. In practice, many investors will blend assets across these classes, but for the sake of clarity in the rest of this guide, our proposed strategy focuses on 3 portfolios: Nigeria equities or local asset, US assets, and global investments. Strategy: diversification across Nigeria, US, and global. Because of Nigeria's elevated risks, a prudent strategy is to divide your investment capital into 3 distinct buckets. Nigeria portfolio, to capture domestic growth potential. US portfolio, to anchor in a more stable market and hedge systemic risk. Global portfolio, to access broader sectors, geographies, and reduce concentration risk. This tri-portfolio structure allows you to benefit from Nigeria's upside while not being overly exposed to its macro and currency risks. It also gives you a mechanism to rebalance based on performance and changes in outlook. Why 3 pillars? Risk mitigation. If the Naira depreciates heavily, the US/global allocations provide ballast. Opportunistic exposure. You don't have to commit your entire capital to a frontier market. Instead, you bet partially and opportunistically. Flexibility and liquidity. US and global markets are much more liquid and accessible, giving you emergency exit options. Currency hedging. Gains in stronger currencies, USD, Euro, etc., help offset domestic currency erosion. Suggested allocation framework. For a young aspiring investor, a balanced starting point might be Nigeria portfolio, 30–40%, US portfolio, 30–40%, and global portfolio, 20–30%. Over time, you can adjust according to your risk tolerance, market conditions, and investment horizon. Now, let's explore how to structure each portfolio in practice. Nigeria stock portfolio, broker, stocks, and approach. Choosing a broker. To invest in Nigerian equities, you need a stockbroker that is licensed by the SEC Nigeria and is a member of the Nigerian Exchange, NGX. For digital ease and track record, Meritrade Securities and Investment One are highly regarded, but there are many other brokers that offer great customer services and real-time investment tracking and trading. Make sure the broker supports both local and cross-border, if needed, transfers, secure online access, and ideally some research support. Stock selection principles. Given the inherent risks, your Nigeria equity strategy should be cautiously biased toward blue-chip, well-governed companies, companies with strong brand, track record, transparent reporting, robust governance, external listings, or cross-border presence. Examples include MTN Nigeria, MTNN, Stanbic IBTC Bank, Zenith Bank, Dangote Cement, Guarantee Trust Bank, GTCO, etc. Low leverage/strong balance sheets. High debt levels magnify risks when interest rates or inflation spike. Exporters or foreign revenue earners, companies that receive foreign exchange income or have subsidiaries abroad, may better weather Naira volatility. Defensive sectors, telecoms, consumer staples, utilities, banking, with good risk management, FMCG, which tend to maintain revenue even in downturns. Paying dividends consistently as dividend yield helps cushion some downside during periods of volatility. Regulated and audited operations favor firms that report under IFRS, have audited accounts by reputable firms, and are subject to regulation by Nigerian and international bodies. Sample stocks to consider. MTNN, MTN Nigeria PLC, a telecom giant with far-reaching presence and brand strength. Although it is not immune to FX losses, for example, it warned of profit hits of up to 90% due in large part to Naira devaluation. Stanbic IBTC, a reputable bank with regional reach and strong governance. First Bank Holdings, large Nigerian banks known for size and liquidity. Dangote Cement, major industrial/infrastructure play. Seplat Energy or other energy firms with export exposure. Zenith Bank, GTCO, Access Bank, growing banking group with regional ambition. Portfolio execution. Start small and scale up as you get comfortable. Use limit orders to control execution price, avoid slippage. Track news, regulatory changes, and FX developments closely. Consider partial hedging if the broker or local derivatives market permits. Aim to hold over medium to long term rather than frequent trading due to low liquidity. U.S. portfolio, brokers, stocks, ETFs, risk management. For your U.S. allocation, use platforms that allow Nigerians or non-U.S. residents to trade U.S. stocks and ETFs from Nigeria. Two such platforms are Bamboo App and Trove App. These platforms allow fractional stock investing, access to U.S. equities and ETFs, and ease of fund transfer, local currency to USD. Be mindful of fees, currency conversion, and regulatory constraints. Asset mix, single stocks and ETFs. Your U.S. portfolio should balance alpha, stock picking, and diversification via ETFs. Single stocks. Invest in high-quality, Well-capitalized U.S. companies with strong growth or dividend potential, e.g., Apple, Microsoft, Amazon, Google, Johnson and Johnson. ETFs use broad-based index ETFs like S&P 500, e.g., SPY, VOO, NASDAQ, 100, QQQ, or sector-specific ones to get exposure to technology, healthcare, consumer staples, etc. Thematic ETFs, such as robotics, clean energy, ESG, AI, etc., for growth tilt. Dividend ETFs, for income orientation. Risk management. Use position sizing. Avoid overconcentration in any single stock. Rebalance periodically, quarterly, or semi-annual. Consider stop-loss rules or trailing stops if your broker supports. Monitor exchange rate spreads and conversion costs when moving funds from Naira to USD. Keep some cash buffer for volatility opportunities. Why include US in your strategy? It offers stability, liquidity, and global leadership exposure. Serves as a hedge if Nigeria underperforms or currency implodes. Provides psychological peace, safe harbor capital. Enables exposure to sectors and trends less accessible in Nigeria, e.g., biotech, cloud computing, global tech giants. Global portfolio, how to engage. Your global portfolio is the third pillar. Using Nigeria banking institution like Standard Chartered Bank Ltd, you can access global investment products, guided by their relationship/wealth advisors. How it works: open an investment/wealth account with Standard Chartered or their portfolio management services. The bank assigns a dedicated account officer or financial advisor who helps you define a strategy aligned with your financial goals, growth, income, risk appetite. The advisor may recommend global mutual funds, international ETFs, global bond funds, private equity or alternative investments, cross-border funds, etc. You can invest in developed and emerging markets beyond the US, e.g., Europe, Asia, Latin America. What to ask your advisor: cost structure, management fees, exit costs, currency fees, expected returns, and volatility. Currency hedging. The bank may offer hedge share classes, geographic and sector diversification, minimum investment, liquidity terms, reporting transparency. Role in your portfolio. Acts as a global hedge and diversification layer. Gives access to assets entirely outside both Nigeria and the US, e.g. European banks, Asian growth, global infrastructure. Balances the frontier market risk you take with Nigeria exposure. Tactical allocation advice and rebalancing. Sample starting allocation for a young risk-tolerant investor is Nigeria, 35%, US, 35%, and global, 30%. You may tilt toward Nigeria if macro conditions improve, or tilt more conservatively toward the US/global side if Nigeria faces stress. Rebalancing strategy. Rebalance semi-annually or annually, adjusting back toward target weights. If Nigeria surges, locking gains by trimming exposure and reallocating to US/global. If Nigeria underperforms heavily, especially due to FX, reduce Nigeria tilt and scale global/US positions. Use thresholds, e.g. if any bucket deviates by plus or minus 5 to 10%, to force rebalancing. Layering and dollar cost averaging. Don't deploy all capital at once. Invest gradually over months to reduce timing risk. Especially for Nigeria, deploy in tranches, e.g. 1/3 every 3 to 6 months. Use market dips or pullbacks to accumulate positions. Hedging considerations. If there is local availability, consider currency hedges, for example FX forwards, futures, options. Alternatively, offset FX risk via stronger exposure in US/global. For large holdings, a small, short hedge might protect downside. Risk controls. Always maintain a cash buffer, e.g. 5 to 10% of capital, to act on opportunistic dips. Avoid overleveraging. Monitor macro indicators, oil price, interest rates, FX reserves, political developments, and be ready to pivot. Case studies. Winners, pitfalls, and lessons. MTN Nigeria and the FX shock. MTN Nigeria is often held as a poster child investment in Nigeria's telecom sector. However, in 2023 to 2024, MTN warned that its profits would shrink by 70 to 90% due to Naira devaluation, despite strong underlying operations. Even as revenues rose, the FX losses outweighed gains. That underscores one of the biggest lessons. A solid business still struggles if its home currency collapses. PZ Cussons and Currency Hits. PZ Cussons, a consumer goods company with extensive Africa operations, cut its dividend by 44% after Nigeria's currency collapse significantly eroded profits. This case highlights how even strong consumer names can be derailed by macro shocks and currency translation. Nigerian stock market in FX decline periods. In academic studies, periods of sharp depreciation in the Naira often correspond to underperformance in the Nigerian stock market in dollar or foreign currency terms. Thus, local equity success is necessary but not sufficient. You must manage currency exposure. Remittance-driven Fed inflows. In early 2024, foreign exchange inflows into Nigeria spiked to $2.3 billion, with foreign investors accounting for a large share of bond market bids. This suggests that capital flows can return when reforms are credible and yields are attractive, an opportunity that can favor active investors that are paying attention. Final thoughts and guidelines for the aspiring young investor. Summary of key principles. Yes, Nigeria has opportunity, but only if approached with caution, discipline, diversification, and a long horizon. Currency risk is your biggest enemy. No matter how well a stock performs, FX collapse can ruin returns. Always diversify. Your three-portfolio structure, Nigeria/US/global, helps you balance upside with protection. Use trusted brokers and banks. Meritrade for Nigeria, Bamboo app/Trove app for US, Standard Chartered for global. Focus on governance, quality, and cash flow. Avoid highly leveraged, opaque firms with weak balance sheets. Don't try to time everything. Use dollar cost averaging and maintain patience. Stay alert and agile. Macro shifts, policy changes, FX movements. Monitor continuously. Rebalance and take profit. If Nigeria runs ahead, trim and redeploy to reduce concentration. Advice to young aspiring investors. Start with capital you can afford to lose or commit over a long term. When investing in frontier markets, volatility is a feature, not a bug. Begin with a modest allocation and scale responsibly. Educate yourself continuously. Stay updated on macro developments, fiscal policy, FX trends, Nigerian politics, SEC/NX regulation, and global market dynamics. Don't ignore the US and global stage. Always keep your global exposure. They may outperform while local markets struggle. Be psychologically prepared. Frontier investing will test your nerves. Expect drawdowns, setbacks, and surprises. Stick to your strategy. Leverage professional advice where possible. Use the support of your Standard Chartered advisor, local broker research, or independent analysts to refine allocations. Have clear goals and horizon. Are you saving for retirement, building generational wealth, or generating income? Your objective should guide your mix. Maintain liquidity and exit options. Always keep part of your portfolio in easily sellable assets to respond to market stress or opportunities. Final word. Is it time to invest big in Nigeria? The answer is maybe, not all in, but definitely with intent. Nigeria represents one of the highest beta opportunities in the investment world. High risk, high potential return, and high volatility. The key is to approach it deliberately, not recklessly, and to allocate with discipline, hedge intelligently, and always keep your eyes on global balance. If you build your Nigeria equity exposure via Meritrade, your US diversification via Bamboo app/Trove app, and your global slice via Standard Chartered's guidance, you have a robust framework to ride Nigeria's growth without being destroyed by its currency crashes. Stay curious, stay critical, and always stay diversified. For making it this far, I have added the links to all the brokers mentioned here for you to check them. Please, always do detailed research before you sign up. Stay safe and stay focused. Thanks. Thank you so much for watching. If you enjoyed this review, don't forget to explore our other videos on investment options and book reviews that can inspire and guide you on your wealth creation journey. That we truly appreciate your likes, comments, and feedback. They help us grow and continue bringing you valuable insights every week. Stay tuned, stay informed, and remember, your journey to financial freedom starts with knowledge. Thanks again for watching, and we'll see you in the next video.